The VIX, or Volatility Index, has been sliding a little bit lower, getting down to its lower levels. UVXY is sort of sliding off into the oblivion. This is the time of where I will step in and start selling puts. We have some economic indicators that could pop the VIX higher, which would send UVXY stock, the ETF against the VIX, one of them, higher as well. My goal, sell these puts, time erosion, let them expire worthless. If I get a hit this week with some economic indicators that would push the VIX up, UVXY stock moving higher, then I might take profits real fast because that's a quick profit for that with limited risk. Let's jump in and I'll show you some charts that I'm looking at, show you some economic indicators that we have coming out this week that would push the VIX higher or could push the VIX higher, and UVXY stock, the ETF against that. Let's jump in. Here's a quick look at the VIX itself. This is the 4-hour bar chart going back into October, and you can see where it had spiked up to about 22. Right now sitting about 13.5 for the VIX. Let's move forward, and I want to show you UVXY stock, one of the VIX ETFs. The VIX, the Volatility Index. It's a measure of the fear index for the stock market. And as you can see, the UVXY stock is sliding a bit lower. They run in tandem except for a couple variables. First, the people who are running this ETF, they need that scratch. So they're pulling a little bit of money out of there. So because of that, the valuations decline somewhat. But the bigger part of that is this is UVXY stock is traded off the 1 month and the 2 month. So it's a future. So there's inflation involved, and so the price reduction kind of continues to move lower and lower. What happens over a course of a period of time, these guys take this stock and they'll do a reverse split twice a year maybe. So seeing it down this low, if you understand that correlation as to what's going on there, you can see why what's happening is happening. It's also one of the reasons why I'm in this really fast. You don't want to be sitting on the VIX for, say, 6 months. Just via inflation and erosion and asset allocation, things like this, you're going to lose. Even if the stock market maintained, the same volatility. It's a variable against you that is a losing variable. So that's something important. But we do have two more economic indicators coming out this week. GDP, I have some charts I'm going to show you real quick on that and onto what I think about GDP. I think it might surprise a little bit to the upside, which could be both good news and bad news for the stock market, which might send stocks slightly higher, then slightly lower, then maybe back higher again. Let's move forward to SPY stock itself. SPY stock, of course, is the biggest ETF. It trades off the S&P 500. And it's one that I'm constantly kind of looking at. Kind of a flat day today, not really much going on until we get the economic indicators. But Thursday's data point is really kind of the big thing here. Should SPY stock fall and people rush into buying puts, pushing up the put call ratio and things like this, this would send the VIX higher, which would mean my short position selling puts against UVXY stock, the ETF, erode without going into the money. Here's the put call ratio. Now, trading at 0.964 at the close today, put call ratio, all right? Number of puts versus number of calls. Real close to 1, usually a little lower. So it's just slightly higher right now, which tells me that two things. Number one, more puts are being purchased, getting it closer to the 1-for-1 ratio. That would push the VIX higher, which would push UVXY stock higher as well. But also the price of those puts, if they move higher, if they start to, if they move from say 50 cents or $1.50 or $5, whatever the current price is, more of them are purchased, and that price of them goes up to say 750 versus 5, you see the PCC, the put call ratio, spiking up higher. That would send the VIX up. My puts on UVXY stock expire worthless, which is the game plan. University of Michigan sentiment versus personal incomes. It's real simple. I start all my analysis with what's going on with the consumer. There's there's actually four major areas. Agriculture, which we don't really kind of look at too terribly much. Government, business, consumers. Government maintains a pretty flatline level of economic stimulus. They barely move higher and higher, but they continually do. Sometimes they go lower depending on what level, municipal, state, or federal. So you don't really follow the government expenditures too much to see how is this going to push the economy. Unless there's a stimulus package, which we have seen a stimulus package, and it's actually having some effect on the economy. Instead of seeing a big recession, I think it countered what the Federal Reserve has done. Great news. A win for Biden, if you will. The economy, broadly speaking. The other two areas are consumers and, of course, businesses. Businesses respond to consumers. Now, they will sort of perpetuate the demand cycle, but they really do respond, and there is usually a delay when they start to build more infrastructure or buildings or whatever it might be, or restock shelving. It's in response to the consumer. Now, consumer demand is really, which is at 70% of the entire economy, a little more than that, is where everything really is driven from, and this is where I initiate all of my sort of analysis and ask the question, is there a misalignment going on right now and I can profit from it? So personal incomes, real simple. You get a paycheck. How do you feel about that? University of Michigan consumer sentiment. There's also a consumer confidence index as well. They go hand in hand. Kind of look at the same things, just slightly differently. Regardless, we can see personal incomes starting to head back upward. Consumption is increasing. Because of that, confidence is rising. There is an ever so slightly delay in confidence after incomes, but it's a pretty good ratio. So if you want to front run any of these kinds of numbers, you first have to start what really drives the economy. Two variables there. Keep in mind this whenever you're kind of looking at something, of course, how many people are employed. Is employment gaining or moving lower, which would add more personal income to the entire aggregate economy? And are individuals who are already employed getting raises? Those two variables would push personal incomes higher, which would push confidence and consumption higher, which would push the demand curve forward. Businesses respond. Businesses, of course, they get that revenue. That revenue turns into profits, which pushes the stock market. Last thing, GDP. You can see overlaid here versus personal income as well. Again, hand in hand. GDP is a backward-looking indicator. We pretty much already know this. We get a second look at the quarter for GDP coming out. Pretty much, I don't really pay much attention to this unless there's some kind of interesting surprise. Regardless, I see that this economy is moving forward. Employment is strong. Unfortunately, so is inflation. We get the PCE index coming out on Thursday, and that's the one I'm really kind of playing. PCE index, of course, will likely not fall as fast as the Federal Reserve wants. We're starting to hear those sounds coming out. So this tells me my UVXY stock, the ETF against the VIX, me selling puts underneath the market, I'm looking for them to expire worthless. I'm looking for any little pop up, and I take profits. That's how I play when I'm looking into the markets myself. I look for misalignment. I'm almost always right in front of an economic indicator, asking the question, does the market kind of have it wrong? The market, the SPY stock, as you could see, was continually moving higher and higher and higher. I say they got it wrong. If that's what you're kind of looking for, breakdown like this for the economic indicators, which would drive the stock market, make sure to hit that like and follow button. Thanks so much for the great comments. See you in the next video.